Hey folks, welcome to a product review at Finominal. Today we're going to look at the 5 largest commodity ETFs trading in the US stock market. Some of these, like the product from iShares, simply track the commodity space versus others, like this product from First Trust, allocates tactically to commodities. So let's explore in terms of how these have done from a risk and return perspective. We're going to kick off with a short factor exposure analysis where we're simply going to run a regression over the last 11 years of those 5 commodity ETFs to the Dow Jones Commodity Index. And what we see is that all of them provide, well, a beta to the index, right, to commodities effectively, right, but of varying degrees, right. So this ranges between 0.8 and 1.3. We can also look in terms of how similar or different those 5 ETFs are by seeing the number of constituents. And so the most concentrated one is the one from Invesco, which has 18 securities in its portfolio, compared to 135 for the product from iShares, which is simply tracking the GSCI, which is a Goldman Sachs Commodity Index, via dynamic roll strategy. Now, so the portfolios are slightly different, right? In terms of from a number of securities, we can also look at the correlations to each other. And we do see that the correlations are somewhere between 0.79 at the lowest and I think 0.96 at the highest. It seems overall that the United States Commodity Index product with the ticker USCI has the lowest correlations on average. Now, compared to other asset classes, as expected, the correlations to equities are low, right? They're not zero, they're around 0.35. They all hover on the same space. And we also see that the correlation to bonds is on the low side. And that, of course, makes kind of like the investment case for commodities that they act as diversifiers. We can move on to performance and evaluate how these 5 ETFs have done since 2014, 15-ish. So we have about 10 years of track record. And we can see that 3 of those products have generated almost identical returns. So this is the product from First Trust, Invesco, and from iShares, the tracking index. The iShares tracking product actually has done worse, right? GSG. And the United States Commodity Index Fund has done best. Having said that, what you do notice is that the performance over this 10-year time frame is close to 0, right? I mean, yes, sure, this did a 20% return, but if you would compute this post-inflation, this would be negative, right? Versus just buying that index, right? The Goldman Sachs Commodity Index via this ETF, GSG, would have been a loss-making investment. We can also look at this in terms of, so this is from a return perspective. We can also look at this from a risk versus return perspective. And the volatility is quite dispersed. We can see that product from iShares that simply tracks the GSCI index that has the highest volatility within 2%, versus these products, right, volatility is approximately half. Having said that, if we move to these products from a Sharpe ratio perspective, right, we can see given that the returns were basically somewhere around 1.5% per annum, right, over the last 11 years, right, which again is not even beating inflation. The Sharpe ratio or short-term interest rates, right, the Sharpe ratios were negative in 4 cases, except for USCI, but it's a paltry Sharpe ratio of 0.10. Now, this kind of like concludes our high-level analysis, right, of these 5 ETFs. The interesting point to make is that, yes, perhaps the index itself, right, GSCI, right, has done worst, but even the products that allocate tactically, like the one from First Trust, haven't done significantly better. Now, there's another way to allocate to commodities, which from our perspective is clearly superior, and that is via managed futures. Managed futures, where the other name is CTAs, which stands for Commodity Trading Advisors, allocate to commodities and of course other asset classes, but the originalizing commodity, and that is one of the main asset classes within a typical managed future strategy, is not to only allocate to the upward trends, but also downward trends. And there is this old saying that betting on commodity is betting against human ingenuity. And what this simply means is that we are continuously evolving our technology and are getting better at making resources cheap. And that, of course, includes the need for the cost for things like steel, oil, right, with electric cars, agricultural products, wheat, and whatnot, right, so that the long-term trend for commodities is negative. And so instead, right, we can pick a managed futures fund that allocates, or bets on up and downward trends, right, within commodities and as mentioned other asset classes. And so here what we've shown is USCI, right, versus managed future strategy from AQR, AQMX. And we can see that this would have been a much more pleasant journey, right, from a total return perspective. And that is kind of like our short review of these 5 commodity ETFs, right, that on a standalone basis have produced pretty, low to negative returns, right? You can still consider them from a diversification perspective, but managed futures are the more attractive way of allocating to commodities from our perspective. Hope that helps. Have a nice day.